Hey guys, it's Hamish Hodder here, and today we're going to be talking about the four most important growth numbers when looking for companies to invest in. These are the four numbers that I use to have a look at past performance and then use them to easily dictate where the future of a company is going. Before we jump into what the four growth numbers are, if you haven't already, make sure you subscribe and like the video if you enjoy. So the four numbers that we're going to be looking into are sales, earnings per share, free cash flow, and equity. And these are by far the most important numbers, and I'll go through in a little bit and explain each of them in more detail and tell you exactly why they're important and why that we can't just look at one, we can't just look at two, we've got to look at all of them, and they've all got to be consistent and growing. So first let's talk about sales, or also known as revenue or the top line. Basically what sales is it's all the money received by a company over a period of time, usually annually or quarterly. So we're talking about all the money generated from the selling of their goods or services. And basically what sales illustrates to us is it's the ability of that company to create inflows of assets for its shareholders. It's the ability of a company to bring in cash and credit for us and for the company to reinvest into other aspects of the business. For a company to be successful in the future, we need to see sales that are not only consistent and growing over time, over a period of usually 10 years we look, but we also want to see that the rate of growth is also increasing so that we can accurately use long-term growth rates as a reliable predictor of future growth rates. Next we have earnings per share. So basically what earnings per share is, it's the net income divided by the number of shares outstanding. And what this tells us is, it tells us how much of the profit or the bottom line, what's left over after all the expenses, how much of that profit is allocated to each share that we are going to be buying. The reason that we use earnings per share instead of just looking at net income is because in a company the number of shares can change. Companies can issue more shares or they can buy back their own shares, which means that the piece of profit allocated to each share that you are buying may differ depending on the number of shares. So it's more accurate to use the earnings per share, and we want to see an earnings per share that is consistent and growing, the same as the sales, and also that the growth rate is also growing. The earnings per share is considered by most to be the variable that has the most impact on the share price. And that's because a lot of people use a ratio called the PE ratio, which is price divided by earnings per share. A lot of people use this as a metric to gauge whether a company is overvalued or not. So a company that has a low PE, is priced at a multiple lower to the earnings than say another company in that industry, that company will look more attractive to investors. Next, let's talk about equity. Equity is essentially the assets of a company minus its liabilities or its debts. And what this tells us is, it tells us how much of a company's assets are owned by shareholders. The rest that isn't owned by shareholders is made up of debt. Equity is created initially when an initial public offering goes out and they raise capital, or they raise capital for a second or third or any amount of time after the initial public offering. But after that, the main contributor to the equity is retained earnings. So this is earnings that is not distributed to shareholders and is not used up in expenses. It's profit that is reinvested back into the business. What we've found when looking at historical prices and historical equity growth is that the equity growth is very closely aligned with share price growth. And that is because it represents true value creation for the investor. I'll give you an example. Let's say a business just adds $1 billion of cash to their balance sheet from retained earnings. And what this does is, it means that the equity of the company has increased by $1 billion because the assets have gone up by $1 billion and liabilities has not changed. What this means is, if I was to buy the entire company, I am now willing to pay up to $1 billion more for that entire company, because essentially the value of what the company has, so it has an extra $1 billion of cash. Therefore, when I buy the company, I get that $1 billion of cash. So I will be willing to pay anything up to that $1 billion more for that company. And that is how that share prices are closely aligned with equity, because as equity grows, the true value for the shareholders is increasing, and therefore it pulls the share price up with it over time. So what we can work out is that long-term equity growth, so this is 9 or more years of compounded equity growth, is a very reliable indicator of share price growth over the next 10 years. And lastly, of course, we want our equity growth to be consistent, growing, and we want the growth rate to be increasing over time. Stop, please. Lastly, we have free cash flow. Free cash flow is essentially the operational cash flow on the balance sheet minus capital expenditure. Capital expenditure being the maintenance and upgrade of any kind of assets that a company has. It's important to look at net income or earnings per share as well as cash, because on the net income, it allows for things such as credit and transactions that money hasn't actually been received for yet. So it's important to look at cash to see what actual money is coming into the company, or leaving for that matter, and what kind of money can be kept as retained earnings and put onto the balance sheet, therefore increasing our equity and therefore increasing our share price over time. So to summarize, the 4 key growth rates that we want to be looking at are sales growth, earnings per share growth, equity growth, and free cash flow growth. We want all of them to be growing over a 10-year period. We want them to be consistently growing, and we want the growth rates of those numbers to be increasing over time. What else is important is that equity is the strongest indicator of share price growth over time. So if we're able to find a company that has those 4 numbers growing over the 10 years at 10 or 15% or more consistently, then we can have a look at the equity growth long term and work out what kind of growth rate we want to use to indicate what kind of share price we think a company will have in the future. Thanks for watching, guys. Hope you enjoyed. Make sure you subscribe if you haven't already. Like, leave a comment, let us know what you thought. Tell me what kind of growth numbers you look into when looking for a company, and I'll see you in the next one.